Hi, and welcome to the Upside webinar on real estate tokenization. My name is Ryan Morris. I'm the head of marketing at Upside, and I'm joined today by my colleague, Brian Wilson. He's our head legal engineer. Brian's also the editor-in-chief of the MIT Computational Law Report, meaning Brian has an exceptional view into how issues around compliance and regulations are being impacted by advancements in technology. In today's webinar, we're going to walk through a quick introduction of Upside, and then we'll dive into some of the basics of tokenization. After that, we'll look at how those basics of tokenization apply to real estate and some of the benefits they provide. And then we're going to walk through the actual steps of tokenizing a real estate project. And then finally, we'll walk through 3 different case studies that will provide a practical perspective into tokenized real estate. So with that, a quick introduction to Upside. And first is, what do we do? Well, Upside works with investors, enterprise companies, and even early stage startups to launch tokens with a focus on safety and security. Our traction, well, we've launched over $1 billion worth of tokens that have been shared to distributed to over 800,000 blockchain wallets. We've worked with a number of large scale companies, including most recently working with Republic on their Note token. Why companies work with us? Well, what are the services that we provide that let them accelerate their businesses? The primary reasons are, 1, to launch a token representing a fund or an investment, even an asset. 2, to launch a token for financing a project. And projects can range from fundraising for a startup or crowdfunding for a specific project or investment. And 3 is to launch a utility token that will be used within an ecosystem. For today's purposes, we're going to focus solely on the first 2 bullet points. Why companies choose Upside? Well, first and foremost would be simplicity. Our product makes the complexity of managing token distributions extremely simple. With that said, compliance and security are probably the 2 most important reasons. Our product is built from the ground up with compliance in mind. And from a security perspective, we have continually audited smart contracts and enterprise-grade security in place. And 4th is experience. We provide guidance from a multidisciplinary team of experts, and this includes deep domain knowledge in legal, regulatory, finance, and blockchain. So with that said, I'd like to take a minute to give a quick overview on tokenization. And for this, I'm going to actually just read directly from the slide because it is really important to get a clear understanding. Tokenization refers to the process of creating digital assets, typically in the form of tokens on a blockchain that represent ownership, value, or other types of rights. The programmable nature of tokens means that the interests that they represent are able to be easily divided into smaller units or fractionalized. We'll be coming back to that bit quite a lot today. In the case of tokenized real estate, the tokens involved represent an interest in the underlying property. Each token represents ownership of a fractional share of the underlying property that may be traded, externally tracked, and that can enforce legal requirements for different securities regulations. These fractional property interests can be bought and sold directly between parties or traded on a secondary exchange for even more liquidity. To add some color around fractionalization, a more traditional form of fractionalization in real estate terms would be the conversion of an apartment building into condominiums. The large single asset is converted into fractions, allowing some or all of the interest in the building to be purchased. But a condo conversion can only fractionalize down to a unit. With a tokenized fractionalization done on the blockchain, the fractions represent a percentage of ownership, whether in a single property or a portfolio of real estate investments. So one token could represent 1% or 1/100%. This provides a lot of benefits related to investor access and liquidity opportunities that Brian's going to touch on a bit later. And finally, from the overview perspective, we want to do a quick dive into securities and what are they. Within the context of securities, blockchains represent a technical evolution over legacy apps. Blockchain technology ensures a more efficient transfer of securities, enables more transparent tracing of interests, and promotes the creation of custom products that are able to generate certain types of incentives for token holders. That said, I want to read through this slide as well because I think it's really important to have a clear understanding, and this is really where much of the regulatory and compliance nature comes into the real estate tokenization. A security itself is a tradable financial asset. Securities are highly regulated by government agencies. In the United States, they are regulated by the SEC. Commonly known securities are common stocks, bonds, and derivatives. A company, entity, or special purpose vehicle, an SPV, issuing the security is known as the issuer. The definition of security varies from country to country based on the regulatory framework adopted by each. Any real estate asset that is tokenized is almost guaranteed to be considered a security. And tokens representing fractional ownership of a real estate asset are able to be traded on secondary markets for security tokens. Now I'm going to hand it off to my colleague, Brian, who's going to walk us through the benefits of real estate tokenization, followed by the process of tokenization within the real estate sector.
I'm happy to join you today. As Ryan mentioned, the key benefit of tokenized real estate is fractionalization. Fractionalization on the blockchain enables a whole host of benefits that we're going to look into now. This notion that fractionalization is a benefit in real estate investing is not a new one. The evolution of real estate investment has always been motivated by expanding the market and making it easier to buy and sell properties. An example of this is the 30-year mortgage. This instrument was created in the wake of the Great Depression as a means to improve access to home ownership for people who couldn't afford to pay to purchase property outright. Similarly, this access is the reason we have things like timeshares. One of the key ways fractionalization provides benefits is by increasing the market for real estate products or increasing access to real estate products. One aspect of this is the opening or expanding of the market to a global audience of investors. Now, thanks to digital exchanges, secondary markets for tokens, etc., it is possible for people all around the world to participate in a tokenized real estate project and trade those financial interests. Another opportunity enabled by tokenized real estate is to include a new category of potential investors and entrepreneurs who have previously been excluded from traditional real estate investment opportunities. Another dimension of this accessibility is access to capital. Tokenized real estate projects can help entrepreneurs fundraise for different projects from investors all around the globe and deploy new and differently programmable real estate investment products that cater to specific investment theses. Additionally, tokenized real estate offers enhanced liquidity, especially when compared to traditional real estate investment. In traditional real estate investment, it can be difficult or cost prohibitive to fractionalize the underlying interest of an asset. But now, thanks to the concept of security tokens, it is easier than ever to fractionalize these interests in an increasingly granular fashion and trade them on markets, secondary markets, digital exchanges with others. This is essentially how tokenized real estate enhances liquidity for real estate investments. Additionally, the infrastructure for executing more sophisticated buy and sell orders of these interests is growing more and more every day. Security token exchanges are becoming more popular mechanism for anyone looking to unlock new value for what economists might describe as a lumpy asset. It is also more efficient than ever to transfer these real estate interests. The ability to program transfer rules and transfer restrictions means there are lower settlement costs, verifiable ownership credentials, automated cap tables for dividend distributions, and reduced errors for manual and repeated tasks. So we've previously alluded to this, but a key benefit enabled by tokenized real estate is the ability to create or configure custom investment products. This type of customization can happen in tokenized real estate through the creation of new types of investment portfolios. This type of investment can also happen through the creation of projects that achieve a customized set of outcomes. For example, you could set up a ownership scheme where fractional interest may be rewarded for performing maintenance on a property. Finally, tokenized real estate offerings enable a new degree of transparency for understanding who owns which interests of a property. And as the markets continue to evolve and become more technologically sophisticated, there will continue to be a whole host of new opportunities available for realizing the benefits of transparency. Now we're going to get more into the practical aspects of tokenized real estate. First, we'll look at exactly how to launch a tokenized real estate offering. Then we'll examine a few case studies that truly illustrate the value of tokenized real estate. So the two most common tokenized real estate offerings are the tokenization of existing assets or the tokenization to finance a new project. Within each of these two categories I mentioned, there's also another way that you can break down and understand the scope of your project. This is by deciding whether or not you want to tokenize a single property or whether you want to tokenize a number of properties through something like a fund. This scope will necessarily be a little bit different depending on each type of tokenized real estate project that you're trying to undertake. But it can be visualized and can be understood in a really nice way that we look at on the next slide. So here's a more graphical representation of the landscape for defining the scope of your tokenized real estate project. You can see it goes a few different ways, but we've kind of isolated it into a few different buckets so that we can set up these compliance measures in a way that's repeatable and predictable. In each of the cases involved, no matter what your scope is, most projects typically undertake to incorporate an entity to manage their project. A lot of these projects incorporate to reduce the amount of liability that they're exposed to. And typically, these incorporations will be referred to as SPVs, special purpose vehicles. Most often, SPVs for real estate tokenizations, especially and including the legacy real estate investment, they're usually incorporated in Delaware because of Delaware's great business laws, their protections for businesses, and the pass-through taxation that they have for LLCs. So next, you'll need to develop your security strategy. Around 99% of legacy real estate investments come through Reg D, but there are emerging options for Reg CF for properties under 5 million and Reg A plus for larger ticket investments, and all of these are able to be tokenized. Additionally, if you're looking to reach an international audience, you can offer securities under Reg S to any international investors so long as you comply with the laws of the jurisdiction that you're offering them in. Next up is private sale. This step will be a little bit different depending on the scope of your project. For projects looking to tokenize a new piece of real estate, this will include raising the funds through the SPV, purchasing the property, and allocating the interest in accordance with the private sale document that you're using in order to execute as a contract. For projects looking to tokenize existing assets, this will be identifying who will receive how many tokens during a distribution. And typically, this will be in accordance with either capital allocations in an operating agreement or some existing cap table that is already in place. Next up is the token launch. It might seem odd that this step is now, before any of the compliance measures have been implemented, but a token has to be launched to a specific address so that those restrictions and rules can be implemented. It's kind of a chicken and the egg issue. The initial launch will usually be to the wallet address of a multi-signature wallet that will be accessible by a project administrator or project administrators. This is where we get to compliance. The project admin will be responsible for making sure all the I's are dotted and T's are crossed with regards to compliance, regulatory issues, and that sort of thing. By making use of what we call access control lists to identify who will have which permissions in a given project, we're able to then implement rules that prevent different actors from doing things that they're not intended to do. For example, there will be one set of permissions for project admins, another set of permissions for investors, and a third set of permissions for transfer agents. If securities are issued in a number of different jurisdictions or under different types of offerings, there can be additional transfer restrictions that are added specific to the securities offering in place. Now we get to token distribution. Here, you're able to distribute your tokens through the Upside app according to what is included in the private sale document and subsequently represented in the access control list. Then you will be able to begin to onboard investors via an email link set up their registration, connect their wallets, and do the AML KYC so that you know the tokens are going who you mean for them to go to, and they can only be accepted by that person. Finally, if you're looking to set up secondary trading, this is when that would happen. You will need to coordinate with security token exchanges to set up secondary trading. This is something that Upside does all the time, and we have really good relationships with all of the security token exchanges out there. And one of the benefits of choosing Upside is actually that we can choose to work with a number of different security token exchanges instead of just one or two. Now we're going to get into some of the case studies. In case study 1, Alice, a portfolio manager, is looking for a way to boost liquidity for her firm's investment real estate portfolio. Some of the properties don't have buyers for one reason or another. Some of the reasons that they don't is because it's difficult to find buyers willing to purchase a full interest in a property. They could be very expensive properties. Additionally, the prohibitive cost of transfer fees and uncertainty about the price of the market, what the market will pay, that could add to it. But by working with Upside, Alice can boost liquidity for her portfolio by tokenizing existing assets, creating an access control list, setting up transfer restrictions and transfer groups, and ensuring vestings are properly accounted for through cap tables. Then the tokens can be sold into smaller individual units, like with what Ryan had mentioned with the 1/1000th of a condominium earlier. You can do that with properties here as well. If Alice wants to go even farther, she can set up secondary trading for her tokens on a platform and create custom incentives for how and when her tokens might be traded with different trading pairs. In case study 2, Bob is a real estate developer looking to break ground on a new project to build an apartment in a fancy part of town. Instead of financing the project with a large percentage of debt, Bob hopes to finance this project through a token launch. By tokenizing all the financial interests in the construction of his new apartment building, Bob will be able to programmatically issue dividends to investors when his units start collecting rent. Throughout the process of constructing and managing the apartment building, investors will be able to buy and sell their interests in the building to others, meeting the same criteria for compliance. In case study 3, Carol wants to develop an innovative new product to make the accessibility of home ownership more possible for people who haven't been able to have it. Carol creates a framework that allows tenants in an apartment building to become partial owners of the building each time they pay rent, instead of actually paying rent. By developing a real estate fund, incorporating Delaware as an LLC, and issuing the securities under Reg D, and transferring shares from investors to tenants each time rent payments are made or fractional ownership purchases are made, Carol has developed a configurable product that provides faster liquidity to investors in commercial real estate deals and unlocks a new wealth building opportunity for the tenants. When the tenants move out, they're able to participate in the upside of their presence in the building by selling their interests on a marketplace. So whether you are looking to tokenize an existing asset, an existing portfolio of assets, or want to use tokenization to finance the creation of a new real estate investment product, Upside is uniquely positioned to help you on your journey. If you would like to learn more, set up a time with our team to discuss real estate tokenization options. Now, I'll hand it back to Ryan, who will take us out of this and get us all on our way to tokenizing some real estate.
Thank you, Brian, and thank you to everyone that's watched this session. We really appreciate it. Like Brian mentioned, we'd be happy to chat with anyone to discuss real estate tokenization or tokenization of any types of assets or business entities. You can find us at upside.gg, and anywhere you see learn more, just click on that, and that'll allow you to set up a time to chat with one of us directly. And we also provide a lot of content. We do a lot of publishing related to this exact topic. So you can find that out more at upside.gg and just click on the blog in the navigation, or you can find us at /the-ledger. Thank you again for your time. We really appreciate it, and we hope this is of use to you.